Mark, does CPI matter?
CPI really matters today. As you know, Guy, I quite often provide context that shouldn't read too much into one print. But I think if CPI clearly beats today, and it doesn't necessarily matter whether that comes through the headline or the core, but if the set of data is overall clearly strong, I think it can really wreak havoc in markets. I think it disrupts both stocks and bonds, and that's because it'll simultaneously disrupt two important narratives at the moment in markets. One is it'll kind of hinder the Fed dovish pivot, which is priced in aggressively. So suddenly it'll make it harder for those cuts to come. It'll kind of raise up the stagflation threat. And with that, it'll also increase scrutiny on the US fiscal outlook, which has quietened down in the last couple of months, and correctly so. In June, we were getting really worried about the US fiscal outlook prematurely, and as we talked about at the time, auctions were actually going okay. We didn't have the fiscal deal pass. We didn't have tariffs come through to inflation yet. Well, now the situation has changed. Last week, auctions were poor. Now we're seeing the fiscal measures actually come through in terms of concrete move changes in the US debt burden in terms of their expected payments over the next year. And we might be about to see tariffs really feed through to inflation as well. So all the factors that were driving a bullish view in Treasuries 2 months ago have changed to be bearish. So I think that if we get a high print today, we see Treasuries sell off right across the curve, we see stocks lower, and we see a knee-jerk reaction for dollar strength.
But Mark, put a number on this for me. What number on core CPI would really start to doubt that September Fed cut? Would it have to be higher than a 0.4?
No, it doesn't have to be higher than a 0.4. I think that the whisper number is that if we get a miss from the Bloomberg consensus today, it'll be a slightly higher print than a slightly lower. That is true. But still, if confirmed, it's a problem. So it's right that we're at the higher end of those expectations. But I think that if we get, let's just say, a number that where the prints are roughly in line, but one or two of them is just 0.1 above expectations, that'll be enough to cause problems. Now, that might be a less strong reaction, but that will still see bonds sell off and stocks sell off from here. The price action in stocks was not good yesterday, and we have to know that US Treasury yields, the long end, have been rising very, very slowly the last 5 days in very, very quiet markets because all the fundamental drivers for Treasury strength are now behind us.
Mark, what does it do to the bond market? I'm looking at 428 on the 10-year yield. Give us a range.
Look, I think 10-year yields are going to rise substantially from here into year end. I mean, year-end's a bit of an arbitrary date. Maybe it goes into next year. But I think the multi-year highs in Treasury yields are going to be tested again over the coming 6 months, coming year. I think that the narrative of the bond market facing a reckoning, which Jeffrey Gundlach said back in June, and I pushed back against at the time, is now valid. It's now the time to play that theme, but for the coming 6 months or so. So you're going to see 10-year yields significantly higher over the coming months.